Look, we've all been there. We found ourselves finding what we thought was a great stock, one that we think is going to rip and give us enormous gains. Unfortunately, we're probably chasing something out of the fear of missing out. And so then when we get in, it plummets 10, 20, 30%, and you don't want to fall into that trap. So let's make sure that doesn't happen again. I'm Corey Halliday, and today I'm going to explain the strategy around classifying stages of a trend, how we look at stage 1, 2, 3, and 4, and if we can pull up a stock chart and identify which stage the trend is in, well, of course, that's going to better assist us in not getting in at the stage 4 exhaustion point when so many of the public are finally chasing in on FOMO, that fear of missing out. We're going to do logical analysis to put the odds in our favor, find a better entry price and a better opportunity. So let's jump in. If we use the chart of the S&P 500, you can see where this race began. The race began back here. This is what we call the breakout point. Now, what does a breakout look like? Usually a breakout is A, breaking up through some resistance, and B, it does so in an aggressive fashion. Good breakouts have momentum, and look at how vertical the market went out of this. Now, following a breakout, the trend should persist in the direction of the breakout. So if the breakout was to the downside, the trend would keep falling. If the breakout was to the upside, the trend would keep rising. In this case, we broke higher, so we get into buy the dip mode, right? In an uptrend, you want to buy the dips and you want to enjoy that ride. Unfortunately, towards the tail end of a market move, or a stock move for that matter, the way that the breakout looks, the verticality of it, the aggressiveness of it, the oftentimes increasing volume, and those characteristics are very similar to what you see at what we call the stage 4 exhaustion. A stage 4 exhaustion will also often go vertical. Very similar to what you see back here can be the way that a market or a stock finishes. Because, again, volume increases and those same characteristics. I always like to use the analogy of running a race. If you are running a race, stage 1 is just resting, consolidating. If you're running a race, well, it's getting a good night's rest. You eat a healthy breakfast that's going to be packed with energy, that's going to give you the nutrients you need, etc., right? So stage 1 is preparation for the race. Stage 2 is when the gun goes off. And if you think about running a race, there's 2 points in time where your adrenaline spikes, where your energy surges, and that's right when the starting gun goes off, right? AKA the breakout point. And also when you see the finish line and you give that final kick, that sprint to the finish. So the characteristics behind the stage 4 exhaustive move and the stage 2 breakout, they're very similar. You'll see a vertical push in the price action. You'll see increased volume, whereas the middle of the race is just the grind. It's the buy the dip. It's the slow and steady. It's it's where you see in price action, it's just stair-stepping its way. But if we look at where things were most extreme, they're most extreme at the original breakout point and they're most extreme at the exhaustion. So the characteristics look very similar. And this is true of any stock that you're analyzing and trading. You can really put it in one of those stages. So if we look at NVIDIA, if you are to compare it to the moving averages and look at the price action, you can see the breakout point and you can start to see the exhaustion levels, right? And then we go into a resting phase. If we were to pull up, again, it just really doesn't matter what you look at. Let's say we were going to look at something maybe in the gold space. Let's say Newmont Mining, a gold miner. Well, if I back this chart out so we can see the original breakout point, you would have to say that this looks like the big breakout point, right? And then look at the stair step. See the stair step? That's the middle of the race. And then look at as we sprint to the finish line. Doesn't the breakout back here, the stage 2 breakout, look very similar to the stage 4 exhaustion? And see how the volume surges? The volume is a sign of energy. It's a sign of momentum. It's a sign of, your adrenaline spike, for lack of a better term. So here we have the stage 2 breakout. Well, that's a sustainable move. That's where you want to be entering, is somewhere near the breakout or in the buy the dips. You do not want to be entering in the stage 4 area. Why? This is the big mistake that people make. This is why we said how to determine exactly when a stock price is overvalued. If we look at the chart and we say, boy, this looks very similar to this, but the context around it is entirely different. Notice, are we extended away from the moving averages? Yes, in both cases. But in back here, you're just starting the race. You're not exhausted. You've just begun, right? You've prepared for this. You have trained and you're ready to continue to run a few more miles. But up here, think of how much buying has been exhausted. Think of all the buyers that have bought back here and here and here and here. There's not just an endless supply of buyers. There's not an endless supply of people willing to pay higher and higher prices. It's a very different determination. Getting in down here in the 40s or the 50s is very different than chasing it up here in the 80s, is it not? So this is where the public just makes a huge mistake and they get caught up in the FOMO. They say, oh, gold's been working, and they hear from their neighbor Joe, and Joe's been making money in gold and gold related assets. And so they say, well, honey, I think we need to go buy some gold related assets. Joe's making a lot of money and we don't want our neighbor making money without us. Let's go jump in too. And they're not using more analytical process and understanding that this is in a big exhaustion. And so they go buy in, and lo and behold, this has a big corrective phase, and they think, oh, the market's rigged. Every time I buy, it goes down. No, it's because they're using emotion. They're not using logic. They're not using charts and analysis. They're not thinking about prices and PE ratios and the things that will put the odds in your favor. So obviously, we do not want to fall into those trappings, and that's where identifying how to exactly identify when a stock is overvalued, aka in its stage 4, is so critical to your success. So now that you understand how to determine if a stock is overvalued, what about a stock that is undervalued? How do we find something that fundamentally, technically, we've talked a little bit about it here, the breakout zone, but how do we find, a growth stock, a stock that might be undervalued, something that has huge potential? We're going to take you through opportunities just like that in this next video, where we're going to talk about finding the opportunity to take advantage of a big price move. Go to the comments and tell me, what's the stage 2 candidates? What are the stage 4 that you're seeing? Comment below and check out this next video.